Today I'm talking about mortgage insurance, not homeowners insurance, mortgage insurance, also known as PMI. A lot of people, one of the first things they'll say, I will not take a loan with PMI. Well, there's different programs and there's different cost structures, and there's a lot of different variations of things, but never say you will not take a loan with PMI. Unless you put down 20% in most cases, you need what's called private mortgage insurance, or PMI, or some sort of mortgage insurance. So there's 4 varieties of loans out there. The good thing is there's 2 of them that don't require any money down and don't require any mortgage insurance. One is a USDA loan. Yes, in Illinois, believe it or not, there are areas that do qualify for USDA loans. So they're backed by the United States Department of Agriculture, and there's no money down. It's similar to a VA loan. So there's no money down, so it's 100% financing. The next loan is a VA loan. So if you're a vet, I strongly suggest you take a VA loan unless you have 20% down. Because, again, you can finance up to 100%, and it's a relatively cheap loan, and there's no monthly mortgage insurance. Okay, so let's say you're not going to put 20% down. So there's 2 options that we have now: an FHA loan, or a normal loan, conventional loan with PMI, private mortgage insurance. Okay, what determines which way, which program is best for you? Well, mainly it's, an FHA loan requires 3.5% down. A conforming loan requires 5% down. So that might be one factor. The next thing is what are your credit scores? I reference credit scores into 4 different buckets: under 700, 700 to 720, 720 to 740, and over 740. So those are the different variations of credit buckets, and those will affect your interest rates. If you're under a 700 credit score and you have a minimum down payment, that's probably going to route your loan with us to go with an FHA loan. If you have 700 or above and you have the ability to put 5% down, we're probably going to look at going with a conventional loan with private mortgage insurance. Now, there's other factors as well. Have you had a prior bankruptcy or foreclosure? So if you have had those, that also tells us which way we might end up going with your loan. On a conventional loan, you need to have a bankruptcy or foreclosure. Bankruptcy out 3 to 4 years, depending on how much money you're putting down. Foreclosure out 7 years. On an FHA loan, you're looking at 3 or 4 years with the bankruptcy and the foreclosure. So those are other areas that we'd look at. So there's a whole variety of factors that's going to place you in what kind of loan you're getting. But again, when you don't have 20% down, one of the best products is VA loan if you're a vet, USDA loan if you're in a rural area, so forth. You can go to USDA.com and check the availability if your house is located in a zone that's deemed eligible. FHA, you will have mortgage insurance, but only 3.5% down. And a conventional loan, you need 5% down, and that would also need mortgage insurance. If you're putting over 20% down, you don't need it on a conventional loan. You don't need it again on VA or USDA loan, but you still, believe it or not, need it on an FHA loan. So this is where we come into play, and we help you figure out the best package for you. So if we need any help, please call me at 630-232-4800, or visit me on the web at 1160mortgage.com, or text me mortgage insurance or PMI, and the number for that is 630-768-1317, or email me at dan.frio, Frio, @gmail.com. Thanks. Have a great day.